What's going on? Welcome back. Ryan here. In this video, we are talking about volatility. Now, I'm going to bring up a chart here. Let's look at the NQ, which is the NASDAQ. And what I want to do here is I just want to come in here to edit studies, and I'm going to remove this open interest, and I'm going to put in Bollinger Bands, right? So this volatility indicator. Now, the reason why I wanted to show you this indicator is because when we're talking about volatility, we're talking about the fluctuation in an underlying price that then contributes to the fluctuation in an options price, right? So what tends to happen here with Bollinger Bands is, and what I'll do is I'll actually add another study. We're going to add this TTM squeeze. And what happens is when the market is about to make a move, when we're expecting volatility or a larger than anticipated move, what happens is these Bollinger Bands often will contract. And down here in this TTM squeeze, you could see that as these outer bands contract, that we also get this squeeze indicator that's coiling up here. And then we can see that the asset then traded below this lower band, and then again this fired and this large move happened, right? So again, we could see that here, right? This almost to me looks like, if we take a trend line here, so this looks like a head and shoulders pattern, right? Here's the neck, here's the head, right down here, and then here, and then kind of like this, right? And this would be like the neckline. So, right, we could think of this as kind of looking like almost like a head and shoulders reversal pattern, right? Coming into the end of 2021, coming into 2022, the federal government is committed to raising interest rates next year, right? So this could be a sign of a major reversal, right? And coupling that with this squeeze here, it's possible that we could see, some significant downside to these markets, right? But the whole point that I'm bringing this up is we're talking about volatility, right? And Bollinger Bands are a very effective way to see when the market is going to potentially start to move, okay? And another really important thing that we want to think about is earlier in this masterclass, I talked about this bell curve, right? And the bell curve representing the average price or the standard deviations that any asset is going to move inside of its range, right? So again, if we come into this studies here and we look at these Bollinger Bands, where the length of the period for calculating this Bollinger Band is 20 periods, right? Maybe we'll make that 21, right? On this TTM squeeze, same thing. The length will make it 21, right? So important to understand that volatility is actually changing, and it will change what this bell curve will look like, right? Because if there's more volatility, it means that this 68.2% range is actually larger. And this is really important to understand, right? Because when we're buying or selling options, we tend to want to put trades on either inside or outside of that range in the bell curve. So let me give you an example of what that means and what that kind of looks like. Okay, we're going to talk more about this when we get into the strategies, but I think it's important to understand and to think about and talk about this when we're talking about volatility as well, because it's all kind of connected, right? So if we come into studies here, edit studies, and we find the ATR, which is the average true range, right? So we can see that on this NASDAQ right now, like its average true range has gone from 191 around 1119 to now being over 360.59 or 341 where we are today. And what this ATR is telling us is that there's been an increase in volatility and that now the market is capable of making larger moves where it could make a move at any time that could be plus or minus, right, 340. So if we come into these options here, right, and we can see that each of these expirations has an associated implied volatility here, right, where it's giving us this implied volatility percent of this option series, right, and it's giving us the actual plus or minus value that the market could move. So for example, if we thought that this was indeed a head and shoulders pattern and that we see that this market is starting to form this volatility squeeze and we're anticipating a move down, right? We think it's going to go down. If we were going to trade some type of credit spread, right, where we were, let's say, going like 30 days out, right, and let's choose 14 of these. Well, this is giving us an implied volatility of 1,000 points, right? So it's saying that this market could go up or down by 1,000. But when we're looking here, right, we're seeing this ATR of 340, right? So how far away is this price from its mean, right, which would be this blue average here in the middle? So this blue average is 1687, right, 16087, and the price would be minus 15762, right, which gives us almost approximately, right, what this ATR is telling us, right? So I would think if I wanted to put on, if we even go in here for less time, let's just look at December end of month and give ourselves 50 strikes, right? And let's say that I wanted to sell a credit spread, right? Something that's above this line, right? Because if this is, if it can make a move back up here, which it might, but we still have this pretty strong head and shoulders pattern with this volatility squeezing to the downside, it could be a profitable trade, you know, right? So let's look at this. We would want to put this above 1687. So let's do, all right, 1680 right here, right? So I could sell the 1680 and I could do a 20-point spread where I might, if we come in here, we're gonna get more into this as we get into the strategies, as we really get in. But what I did here is I just constructed a call credit spread, right, where I'm selling a call and I'm buying another call. That's a 20-point wide spread for a $7 credit, which means that my risk on this is 14 points. So if I analyze this trade and we come in here and look at this NQ and we look at this risk profile, right? This is why I love Thinkorswim, because it's really easy to experiment and look at numbers and get a graphical representation, right? So we're looking at this NQ here, right? I'm just kind of thinking outside the box, giving some examples here of volatility and how I might look at a trade or a situation and then formulate a trade that has a high probability of winning. And by doing that, I've selected strikes that are over this mean value, kind of outside of this average true range, with a pretty strong reversal pattern and this volatility squeeze. And now we've set up this trade where the risk on this is you're risking $2,600 to make $1,400, right? So when we get into actually looking at these strategies in more details, we're going to talk a lot more about risk and how this all works, and what type of adjustments produce what results. But just know that volatility is an option trader's best friend, right? Whether you're buying options or whether you're selling options, volatility is what tells us not only what type of trades we should make, but where we can profitably make them where the odds are in our favor, okay? So again, I love talking about this. I love helping and being of service. I hope that you are finding value in not only the content, but the way that I'm presenting it. I would love to hear from you. I would love your feedback. If you have any questions, feel free to reach out. I would love to answer questions you have. Always looking to make improvements. And as always, I will see you in the next video.